All right, welcome to the third homework assignment. So the focus of this one is going to be overall adjusting entries and closing entries, and of course finishing up the accounting cycle. So we'll start out with dealing with the adjusting entries, because that's one of the big points of contention in this one. So again, for each of these, you're going to consider everything separately. And again, there are four possible combinations that you'll be dealing with here of deferred revenues and expenses. So first up here for part A. All right, so it says an analysis of the $28,000 balance in unearned fees determines that $15,000 worth of jobs have yet to be completed. Remember, the trick with deferred revenues is that they can tell you one of two angles. They can tell you, like, okay, here's the amount of revenue that needs to be recognized, excuse me, or they can tell you this is what still needs to be in the liability account after adjustment. So you always have to pay attention to the language to determine which situation you're in. So here, if I tell you $15,000 worth of jobs have yet to be completed, I'm telling you which should still be in the liability account after adjustment. So in order to get the correct entry here, you'll have to take the 28,000 minus the 15, and that's where you're going to get the 13 you're looking at here. So in other words, we need to take 13,000 out of the liability account and reclassify it as fees earned, because that's the portion that's been earned. The other 15 is still unearned. So what you're looking at down here is what will happen after you plug that adjusting entry in. So because there's the beginning balance in the liability, $28,000 credit balance. The adjusting entry will take 13 out of it, resulting in a $15,000 ending balance, which is what we're looking for. And again, this is an example of a deferred revenue. Now for B, office supplies have a beginning balance of $550. During the month, an additional $2,000 was purchased. Estimated value of supplies unused is $625. So now, again, the same trick is going to apply to deferred expenses, but it's a little different because now I'm either going to give you the amount of the expense, in which case that's the amount of the adjusting entry, you're done, or I'm going to tell you which should still be in the asset account after adjustment, in which case, once again, you have to do a little math, as was the case for the deferred revenue example, where I gave you the liability angle. So if I give you the asset or liability angle, that's when you got to do some math with the deferrals. So here, what's the information I'm giving you? Unused supplies are $625. So if it's unused, that means it's still an asset. So that's what should be in the account after adjustment. So step one for this one is figuring out how much was available. $550 at the beginning, plus $2,000 means $2,550 was available, minus $625 will give you $1,925 as the amount you need to expense in this case. So that should be your supplies expense debit and your supplies credit. So again, when you plug that supplies credit in here, that's the adjusting entry amount right there. You take that $1,925 out of there, it will result in an ending balance of $625. That's what we were looking for here. So everything is copacetic. What was next up here? Next slide. C. An analysis of the $5,000 balance in prepaid insurance determines that $3,500 of insurance benefits have expired. So this is another deferred expense we're dealing with. So again, which angle am I telling you? Am I telling you the expense angle or the asset angle? Well, look at the language. If I tell you benefits have expired, expiration sounds like what? Something that's used up, therefore that's the expense angle, you're done. You don't have to do any special math here. All you need to do is just book insurance expense debit, $3,500, take $3,500 out of prepaid insurance, which will result in a $1,500 balance of prepaid insurance. So once again, I could have told you that the amount of insurance contracts that are unexpired is $1,500. You would have still gotten the same entry that you're looking at here, but in that case, you would have had to take the $5,000 minus the $1,500 to get the $3,500. That's the difference, is how much work you have to do. Right, now, D is a depreciation example. This also falls under the heading of deferred expenses, but we'll never ask you to do any math here for this, at least until we actually go over how you calculate depreciation, but that's not pretty much until the last portion of the class. So I'm just going to give you an amount here. So $12,500 is what you have to book here. So you just have to remember the basic debit and credit. So that means we're going to debit depreciation expense and then credit accumulated depreciation on equipment. So just a quick recap of this account here. Again, what do we call this? We call this a contra asset account, because what's it doing? It's accumulating the portion of our assets or fixed assets that we have devalued so far, that we depreciated to date. That's why I said it's basically an accumulation of valuelessness. There's one way of looking at it. And remember, we're using that instead of directly debiting out of a fixed asset account, because again, as I demonstrated in that video, it would basically change your information set, right? It would kind of dilute and somewhat pervert, like what do you actually have on hand? In other words, you want to preserve original purchase price, and then at the same time you can preserve how much we devalued it, depreciated it to date by adding this account. So that's the good thing about adding accumulated depreciation to your. I seem to have had a bit of an artifact hanging out when I did the slide here. There, we'll work around it though. It's not the end of the world. So again, it should read for that one. I'm scrolling up in my own version here. Okay, what did I have there? Okay, so it should be $100,000 note receivable remains outstanding at the end of the month. That's the portion that was painted over right here. Outstanding at the end of the month. Interest earned but not yet received or recorded on the note amounts to $1,000. So we can still complete it here, and it's in your notes that are available with the class, so it's no big deal. Just one of those weird things that happens when you do a slide based upon a screen capture, a print screen with a Word document. Sometimes you get strange things like that. So again, this is just what was still sitting there outstanding at the end of the month. So we have this $1,000 that again was earned. We just haven't received it yet, because why? Because the timing of the note wasn't due yet. That's the bottom line here. So again, this falls under the heading of an accrued revenue. So we need to record the fact that it's receivable because we haven't been paid yet. So interest receivable is a specialized receivable in this case for $1,000, and we have to recognize, of course, the most important portion here is to recognize the interest revenue that's been earned for $1,000. Again, for accruals, there's no like angles here or anything like that. Just circle the E to be consistent with the other examples. That's all I'm doing there. All right, got distracted by that little artifact there. Last trio here, F. I don't see any weird artifacts in this one. Good. In this case, we have a $200,000 note payable, same as the note receivable, remains outstanding and not meaning nobody's paid on it yet. Interest incurred but not yet paid or recorded, of course, on the note amounts to $3,500. So same idea here, except in this case we have interest expense incurred but not yet paid. So again, that's telling us what the portions of the, like what are the two halves of the entry, what do they look like? So we have to recognize interest expense, so debit that. And then we owe that money, so that's why we have offset to interest payable. Again, we usually come up with specialized payables and receivables when we're talking about interest, rather than dragging them through and integrating them in the AR balance. Okay, next up, G, we had 10 jobs totaling $33,000, completed and earned at month end. So again, we completed them and earned them, but are not entered into the billing system. Usually this is the truth, is we're not going to do this entry unless we have a problem with timing. In other words, we completed something, but we have a billing lag. So because of that, we'll have to enter this, because again, it's been earned, but not yet received, or in this case, even entered into the billing system. So we need to record some sort of receivable. It can be AR or fees receivable would be acceptable. And the offset has to be, of course, fees earned. We got to recognize that revenue has in fact been earned. And then lastly, H, very common one that you have to deal with, is a corporation employs 10 full-time wage employees who work 5 days a week, Monday through Friday, and earn on average $200 a day. So the current period ends on a Wednesday. All payroll has been paid through the previous Friday. So in other words, we have to accrue what? 3 days of payroll. So the first thing you have to figure out is how much are you paying these people per day? So that would be, so the math here is going to be what? So it's going to be $200 on average each times your 10 employees. So that means on average you should be doing what? Booking $2,000 of payroll per day. And how many days are outstanding? Monday, Tuesday, Wednesday. So times 3 days equals what you're looking at there. So that's where the $6,000 comes from. The $2,000 a day for 3 days. So you have to book what? Wages expense incurred, but not yet paid. So usually it's customary to use a specialized payable for wages like that. And again, that's another example of an accrual, but in this case it's an accrued expense. So you'll note, even though our accrued expense up here violates the rule of is there any previous transaction, because yes, I would say that's a previous transaction when you book that note payable, obviously. But if you look at the pattern, expense debit, wages is some sort of payable credit for both of them. I mean, they both follow that same pattern, so that's why clearly we're dealing with an example of accruals in both instances, because they simply follow it. Same thing is true with, this is a classic example of an accrued revenue. So we have some sort of receivable debit, fees are in credit, in this case, revenue credit. And then this one here, again, this is another one that violates the rule, because we have something we previously booked, probably booked that $100,000 note receivable, but guess what? When you book the entry for the, the journal entry for the adjustment, guess what you end up having? You have a receivable debited, some sort of revenue credited, same as you have here, receivable debited, revenue credited. So that's why they fall under the heading of accruals, even though they do slightly violate that rule that was discussed earlier. In other words, usually there's no previous transaction that you can point to as a source or the impetus behind the entry itself. All right, so that concludes the first portion of the third homework assignment. And this one's pretty rangy, so this might take a little while to get through, but just take it one bit at a time and you'll be good to go. So see you in the next one.